If you've ever seen a high earning household suddenly get into real estate and thought, why now? There's a good chance it wasn't a career change, it was tax planning. Let me explain how this usually works. Quick note, before we start, I'm not a CPA and this isn't tax advice. This is simply how these strategies are commonly structured when wealthy households use real estate as a part of a bigger plan. Always talk to a qualified tax professional before making decisions. Now, with that out of the way, here's what most people miss. From the outside, it often looks like this. A high earner starts making serious money. Then their spouse gets involved in real estate. Maybe they get a license. Maybe they manage rental properties. Maybe they step back from a traditional job. People assume it's a lifestyle choice. Most of the time, it's not. It's structural. When high income households invest in real estate, cash flow and appreciation matter, but they're only part of the equation. The other piece is how real estate is treated from a tax perspective. Real estate is one of the few asset classes where you can generate income, build equity, and still show paper losses. Those losses often come from depreciation and operating expenses, not because the investment is failing, and that's the key distinction. Here's the structure you'll see over and over. One person in the household has a demanding W-2 job, long hours, high income, very little flexibility. The other person has more control over their time. The second person becomes actively involved in real estate, managing properties, coordinating maintenance, handling tenant issues, overseeing operations. The level of involvement matters. Under certain circumstances, active participation in real estate can change how losses are treated for tax purposes. Things like depreciation, again, paper losses, may be allowed to offset other taxable income depending on the structure, involvement, and income thresholds. That's why many families intentionally self-manage instead of outsourcing everything. Not because it's easier, but because structure matters. If you're investing in real estate or thinking about it and want to understand how ownership and involvement might fit into a bigger plan, I offer short Zoom calls. No sales pitch, no pressure, just a clear conversation on how these strategies are commonly structured. The Zoom link's in the description. None of this is flashy. There's no social media version of tax efficiency. From the outside, it just looks like, oh, they're in real estate now. But behind the scenes, it's deliberate. Real estate isn't just about buying property. It's about who owns it, who manages it, how income is categorized, and how decisions compound over time. That's why wealthy families focus on structure before scale. The biggest takeaway is this: smart real estate investing isn't loud. It's not about hacks or shortcuts. It's about understanding how ownership, involvement, and long-term planning fit together, and asking the right questions with the right professionals. The smartest strategies usually are the quiet ones. If this helped you see real estate differently, hit the like and subscribe button. And if you want a calm, no pressure conversation about how this fits into your situation, the Zoom link is below. I'll talk to you soon.